Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. When you buy in stocks, individual stocks, it can be sometimes very challenging. And the reason I said that is because you're buying individual stocks, hoping that, you've done your due diligence, you've done the research, and you're hoping that it's going to go up and so on. And the ultimate goal is to kind of beat the market. But when you look at the market, for example, the S&P 500, it consists of 500 different companies that are all in different sectors. So what you need to do is have diversified portfolio. You can't just have all, every single sector, basically oil company. You can't have all the consumer staples. You can't have, discretionary or healthcare. You need to have a bit of everything in order to be able to not only beat the market, but also have a diversified portfolio that can sustain when things are not great. So, for example, if you had oil companies in the last few years, then you're doing really well. Okay, really, really well, because you've had, the oil prices going up and these oil stocks are going up. If you had tech companies only, then you are feeling the pressure because they have been going down quite a bit. If you are in the healthcare sector, only buying healthcare, then obviously you're okay because they are kind of defensive. If you are consumer staples or defensive, if you like, then you are okay because they have not done that badly. So it is very tricky to find a balance. And what I try to do here and what I try to share with you guys is to bring you to your attention different companies in different sectors so you can pick the best out of each sector. So you can build that portfolio that is sustainable, that is growth oriented. And if you are quite young, invest in these companies now, and then in 10-15 years down the line, you will see the difference, inshallah. And that's the plan. So what I want to do today is I want to focus on the technology sector. So I found 10 different companies in the tech sector that pay dividends, okay, and have increased those dividends and so on. Majority of these companies have excellent free cash flow, low debt, and they have a low payout ratio. So I want to share with you these 10 companies. So let's get started. As usual, I'm just going to use the same, basically the headings that we normally use. So the first company that we're looking at today is ASML. ASML is a semiconductor company, is the company that creates the devices, or basically that are used to manufacture these things. Okay, they have a wide economic moat. There's no other companies that can actually manufacture the equipment this company has. Basically, the price right now is $665 per share. It has a dividend yield of 1.47. Latest increase was 5%. The 5-year growth rate is actually 33%, which is absolutely huge. The reason why I've included in this. And the payout ratio is only 34%. 13 years of increase in that dividend. The annual payout is $6.89 according to Yahoo Finance. Safety is 82%. Normally 90% and above. Basically 99% is the highest. So 80 is absolutely wonderful. Profit margin of 26%, let's call it 27%, and return on equity is 67%. Free cash flow, we're looking at about $8.4 billion, and total return of the last 10 years, we're looking at about 25% almost. Next year, they expect it to grow 20% and then 30% after that. 14% discounted right now, $760 per share is where it should be. Now, I have a plan, and I'm going to share with you guys what I'm doing with this company, because I do own it in my portfolio and I have a plan for it. So by the end of this week or early next week, I will actually announce that news. If you haven't, by the way, if you still haven't basically signed up for the Patreon, please do so. It actually helps the channel, like I've always said to you guys. And also it is basically, you get a lot of things like the ETF trackers, you've got the US and the UK trackers, the dividend trackers and so on. And you got the buys and sells that I make. So I'm actually announcing quite a few things that through the Discord. So I'm gonna try to grow this as much as we can, inshallah, moving forward. So if you haven't subscribed to it yet, please do so. It really does help the channel. Okay, right, now going back to it. So I will announce what I'm doing with it very soon. So the next company we're looking at is Microsoft. And I'll talk about Microsoft in a second as well. There's another news I've got about this company. Market cap right now is just across about $2 trillion. It's gone up since the ChatGPT stuff. Okay. Company has a wide economic moat, $267, and it pays 1% dividend. Latest increase was about 10%, 5-year growth rate 10%, payout ratio 29%, and dividends, they have increased that dividend for 12 years in a row. They will pay you $2.72, 99% safety, and profit margin of 33%, and return on equity of 39%. Free cash flow right now is $59 billion. Total return is about 26% in the last 10 years. 15% growth expected next year, and then 12% years after. 15% discounted right now, $310 per share is where the company should be. You know I love this company. And I've always said absolutely amazing company, and I talked about it before. Even Zoya says is about 5% non-Sharia basically questionable, if you like. And I've always said, nah, that's not true, because if you look at Bing, for example, the revenue that comes from there is not about 5% of the overall business. But now it's going to be tough to actually, going forward, I think things are going to change, because I started using Bing for the first time in God knows how many years. Remember the Explorer days? We haven't used the Bing for a long time, but now I started using it. The reason I started using it is because the ChatGPT and the AI basically inclusion side of things. So are there more customers or more people like myself that are switching from Google to Bing in the next few weeks, months to come? And if that happens, obviously the advertisement will come with that, because a lot of companies will then want an advertiser with them, and that revenue is going to grow. Is that what the company wants? It looks like it. So if that happens, then the company is going to go to the same way as the Facebook and Google, right? The Meta, Alphabet, if you like. So I'm not sure. So we'll see what happens, but watch the space. I might get rid of it before it gets to that stage, because right now I'm up. I don't know how much I'm up, but I'm up quite a bit. I think it was, there you go. I'm up 32% or £800. So I might take that money and go somewhere else, because I don't know how I feel about it. I'll be honest with you. We'll monitor the situation next couple of weeks and see what happens, okay? The next company we're looking at is Qualcomm. Qualcomm is one of the businesses that I own in my portfolio. It basically has a 144 billion market cap in narrow economic moat. Again, it's one of those companies that works with technology companies like Apple, for example. They create a lot of the chips that go into these companies, a lot of the 5G. They have a lot of patent, this company. That's why I always said it's not a wide economic, should be wide economic moat, because of that patent that they have. Other companies pay this company royalties to actually use that patent, if you like. So $130 per share right now, 2.27 dividend yield. Okay, latest increase was 10%, 5-year growth rate of 5%, 25% payout ratio, which is very, very low. Dividend streaks about 19 years. So hopefully in 6 years down the line, okay, this company will become a dividend aristocrat. Annually, they will pay you $3, 80% safety, profit margin 27%, 71% return on equity, free cash flow about $8 billion, and let's call it 8.5% total return in the last 10 years. Next year, 22% growth, and then after that, 7% decline. And again, we know why that is, but I don't think it will be that much. I think it will be lower than that if you think about it. Okay, we've talked about that before. So 8% discounted right now, $140 per share is where the price should be. The next one is Cisco. Cisco is another company that I own in my portfolio. It looks like I'm actually showing you my portfolio right now, but it is one of those great companies. $194 billion market cap, wide economic moat, $47 per share right now. Dividend is 3%. It's been above 3% for a long time, which is quite nice. I am buying more of this company as time goes by. 2.7 latest increase, 6% 5-year growth rate, payout ratio 22%, and dividend streak 11 years. That they have increased that dividend. Annual payout is $1.52, 91% safety, 22%. Total profit margin and return on equity is 28%. Let's call it 29%. Free cash flow of $13 billion and 10% or about 11% total return in the last 10 years. Next year, they expected to grow that earnings by 8%, then 7% after that, which is one of the reasons I love this business. as you know, one of the oldest companies out there in terms of technology side. It's not really that old, but it's been around for a while and still growing about 8%, 7%, which is quite good. 12% discounted right now, $54 per share is where it's at. I want to make sure I own quite a bit of this company before it gets to that price target. So we will see where we are. Next one is another one that I own in my portfolio. Okay, Broadcom, $248 48 billion market cap. Again, is one of the companies that works with companies like Apple and so on, producing quite similar to Qualcomm in terms of the Internet of Things and so on. It has a narrow economic moat, $598 per share right now. Dividend yield 3%, which is quite nice. 12% increase in the latest increase was 12%. Dividend streak, 5-year growth rate is 29%, which is absolutely huge if you think about it. Okay, the closest is ASML. Payout ratio is 45% only, and they have increased this dividend 12 years in a row. Annual payout, check this out, $18.40. Okay, safety, basically 67%, so it's definitely safe. Profit margin 33%, return on equity we're looking about 51%, and free cash flow, $16 billion of free cash flow, total return in the last 10 years 34%. Next year, I hope that continues. Remember, this does not tell us much, to be honest. This tells us where the company has been, but going forward, obviously, we will hope that will be the case, if you like. Next year they expected the earnings to grow about 7% and then 8% going forward from there onwards. 5% discounted right now, $624 per share is where the price should be. The next company that we're looking at is TXN, that's Texas Instrument Incorporated, $159 per share. Wide economic moat. This is one of those companies that have a lot of analog devices, including calculators and so on. $176 per share, 2.8 dividend yield. Latest increase was almost 8%, 5-year growth rate of 17%, payout ratio 28%, 19 years of increase in that dividend, $4.96, almost $5 for every share of this company that you own. 90% dividend safety, 43% profit margin, 61% return on equity. Free cash flow is about $6 billion. Total return in the last 10 years, we're looking at about 19%. Next year, they're expecting earnings to grow about 11%, then 10% the year after, and 5% premium right now, and $168 per share is where the price is at of this company right now. The next one is Accenture, company that I've talked about recently, company I will definitely at some point add to my portfolio. It hasn't hit that top price target yet, so I'm waiting for this company to come down, and it looks like it wants to go up, right? But basically, it's a great company. It's basically a consultant firm. They work with a lot of the biggest companies out there from the technology side of things. $179 billion market cap, wide economic moat, $284 per share, and it has 1.57% dividend yield. Latest increase was 15%. 10% in terms of the 5-year growth rate, 38% payout ratio, 17% in terms of 17 years of increasing, that dividend, and $4.48 is what you will get paid for this owning a stock of this company. 92% safety. In terms of profit margin, return on equity is excellent, great, absolutely amazing. And then free cash flow, we're looking at about $8.8 billion of cash sitting in the bank right now. And basically, let's call it 15.5% total return in the last 10 years. Next year, they expect it to grow about 10%, then 10% after the years after. 10% premium right now, $258 per share is where it should be. I want this to come down maybe about 15% to just have a margin of safety. If that happens, then you will definitely see this company in my portfolio, inshallah, going forward. The next one is one that's on the news today. That is TSM. TSM basically is on the news today because Warren Buffett basically owns the stock and trimmed it recently. So he just published his latest basically buys and sells. So he actually trimmed it. For that reason, the stock is down, I think. Let me check. Yeah, as you can see, is almost 7% down today. Okay, and just for that reason, because Obviously, a lot of people bought it when he bought it, and now they're selling it because he's selling it. And that is the worst thing you could do as an investor. Obviously, do your own research, do your due diligence, hold on to the stock for the next 5 to 10 years. Because some random guy bought it, it doesn't mean you should follow them or whatever, okay? It's really important, because you see someone else buying a stock, it doesn't mean it's good for you, okay? And the people that are selling it right now, they're just selling it because they just, I don't know. He sold it a while back. It happened in the last 3 months. So at some point in the last 3 months, he sold it. And you're selling it now because all of a sudden the company for that you were holding on to the last month or whatever is now it's no longer great because he sold it. Come on, man. People need to think about these things, okay? But a great company, 480 for 68 billion market cap. It has wide economic mode. It's one of the biggest companies in the world. For the reason it is because every single semiconductor company goes to this company to manufacture their own. So Apple goes to them and they do it for them. So Warren Buffett has actually increased his stake in Apple but reduced this one. So in a way, it makes no sense for people to sell anyway. $90 per share right now, dividend yield of 1.8, latest increase was 10%, 5-year growth rate is 9%, payout ratio 27%, dividend streak of 3 years, and payout is not that great, 1.4 or $1.40, safety is 62%, profit margin 33%, return on equity 31%, free cash flow of almost $17 billion. This is probably one of the reasons why basically people own this stock, because that high growth as well as the profit margins and return on equity, free cash flow there. Total return in the last 10 years almost at 20%. Next year 26% expected to grow in terms of earnings, then 22% every year for the years after, 32% discounted at the moment. After today it will probably be about 35%, if not more. And then $140 per share is where the stock is at right now. The next one is automatic data processing. I've included this in this sector, although when you look at the S&P 500, it's included in the industrials. Okay, I think this company is more to do with technology than actually has industrials, but is a company that I own in my portfolio. They do a lot of the processing in terms of paychecks and all of that stuff and payrolls, whatever. 93%. What's going on here? Okay, yes. Sorry, I thought that was the price. I was like, what just happened to the stock? 93.6 billion market cap. Okay, it has a wide economic mode. It has a price of currently $225 per share. For a second, I thought that was the price. I was like, what just happened to the company? Dividend yield 2.23. Latest increase was 10%, 20%, 13% in terms of the 5-year growth rate. 58% payout ratio, which is slightly higher than I would like to. Okay, it's definitely higher for these companies that I've owned in here. Some of the companies I own in my portfolio in the technology sector. But it's fine. It's still doable, because if you look at the 97% safety, which is quite nice, 47 years of increasing that dividend, $5 basically dollars for every share of that company that you own. Total return on equity, profit margins is absolutely amazing. They have almost $3 billion. 15% total return, and then next year they're expecting the earnings to grow about 11%, then 13%. It's discounted right now about 1%. $228 per share is where the price should be. And finally, the final stock that we're talking about today is Applied Materials, again another company in the semis. Okay, 96.8 billion market cap. It has a wide economic mode, $116 per share right now. The dividend yield just below 1%, 8.3% latest increase, 21% 5-year growth rate, 13% payout ratio, which is really low, and 5 years of increase in that dividend, about $1 for every share of this company that you own. That's what you will get. Safety 86%, 25%. Profit margin, return on equity is absolutely amazing. $4.61 billion of free cash flow, 24% total return in the last 10 years. For whatever reason, Yahoo Finance doesn't have the next year for this company. but in the next 5 years, about 11% growth, 4% premium right now, $110 per share is basically where it should be. There you have it. That's 10 different companies. And what I would have done, like what I'm doing, to be honest with you, I've picked the first 5 of these companies and then this one here. Okay, so I own 6 in this. Why? Because of the growth side of it, the fact that they have a low debt, the payout ratio is quite low, the safety is absolutely amazing. So I can see holding on to this company for the companies at least for the next 5 to 10 years. Whereas I'm struggling with certain companies in the industrials and consumer staples where the debt levels goes up and down and they cut their dividend, whatever. These companies do not do these things, and they are actually, some of them becoming different aristocrats, some of them are getting there, okay, which is absolutely amazing. You've got different dividend kings and so on. So yes, they do have a low level of debt and so on. And when it comes to the Sharia compliance side of things, just pause the video just to have a look at it. Okay, but majority of them have absolutely no issues. Broadcom is basically the one that has the highest in terms of the interest-bearing debt. Interest-bearing securities is actually all fine. But yeah, there you have it, 10 different companies that you could potentially look into. Like I said at the beginning, if you haven't looked at joining us on the Patreon, please do so and join basically the discussion. Inshallah, in the long run, I would like to build this up so we can all have that discussions and help each other as brothers and sisters. Have a wonderful day. Assalamu Alaikum.